Hello, everyone. Making sure my mic's on. Only about a minute more before we get going here. So the just so you're aware, the this lecture is definitely a lot shorter than the previous ones. I think last time I did this, it may have been done in 45 minutes or something like that. I'll also be restreaming. I'm not going to do it live, but I'm going to restream some practice problems related to Chapter 22. And so I had done that in the spring, I think in between the Chapter 22 live lecture and the Chapter 23 live lecture. And a lot of the students just wanted me to walk them through some of the practice problems. And so I'll restream that, or I'll just post it in the folder. But it's already out there. But I'll just make sure that it's something that everyone's aware of. But anyway, again, I hope you all are doing well. We're going to kind of jump into things. Just as a quick recap, overall the test did go well. I'll be sending out an email later on today. You should just be aware though that there's only a 7-point curve on this one because several students did very, very well. And so I kind of anticipated that. And I would imagine for this last test, the curve will probably be less than 10 points as well. But again, everyone's doing very, very well. So keep it up. Otherwise, let's kind of get moving on this. And so we're talking about Chapter 22. And this is accounting for changes or counting changes in error analysis. And for a lot of students, this I'd say conceptually is pretty challenging because you're trying to kind of disentangle a lot of different things. One reason why this chapter is at the very, very end is because it really does require that you understand a little bit of the accounting for all kinds of different things. And so it's bringing in deferred taxes and how you account for receivables and fair value adjustments, and it just can touch on so many different things. And so it's at the end of intermediate too, because hopefully at this point in time you've really seen everything. And so there's a couple of things before we jump too far that I want you to be aware of. First of all, I cannot give you an example of all the potential types of things you're going to have to do. That is just impossible because there are hundreds. However, on a test or in the way that I evaluate you, I am by no means going to have a very detailed question. I'm not going to have one where it's really difficult for you to even remember how to do the accounting. And so I just want you to be aware that the test is going to have some examples that are unique, but they're not going to be examples where you don't know how to do the accounting. So it'll be basic accounting, but it could cover a wide breadth of types of situations. And so I just want you to be aware of that. And as we kind of walk through this, you'll start to see that more and more. All right, so a little bit of background here. The first category of things we're going to be talking about are accounting changes, and the major one really that we're going to be talking about is this first one, and that's a change in accounting principle. And so a change in accounting principle is when a company goes from one acceptable method under U.S. GAAP or applying a principle in an acceptable way to a different but also acceptable way. So as an example, when you do inventory, you can account for inventory using the LIFO method or the FIFO method. So either one's acceptable, and companies are permitted to change between the two. But if you change between the two, that's going to change the way that you report your inventory account balance. It's going to change the way that you report net income. And so that is an accounting change. Another example of a change is if there is a change in accounting estimate. So Henry asks, questions be chosen. So when you're talking about what we cover as far as errors and changes analysis, these will be things that you've covered. Now, not necessarily as an example just in Chapter 22, but it will certainly be some sort of accounting topic that you have already seen. And so the second type of accounting change is a change in estimate. As an example, we know that when you depreciate property, plant, and equipment, you can change the useful life. And so if you extend the useful life, it's going to change the amount of depreciation expense that you record or you would have recorded. And that's a different type of accounting change. Now, this is one that we are not going to cover in this class, but you should be aware of it. There's also what's called a change in reporting entity. So this would be a reorganization of subsidiaries. And so, as an example of that, a few years ago, General Motors had, I mean, they must have had like 10 different subsidiaries because they had GMAC, which is their credit agency. They had Chevy. They had GMC. They had Cadillac. At the time, I think they had Saturn, Pontiac, and a few foreign divisions, and Oldsmobile, and all Buick, all these different subsidiaries. And so they started to get rid of some of those lines of cars, like Pontiac. They don't make Pontiac anymore. And so anytime that changes, well, now your entity has changed. There's going to be certain transactions that had happened between Pontiac and GMAC or AC Delco. I think they also own them as a parts company. So some of those things are going to start to change. And so now the way that you report is going to be different. And so that's unacceptable. They're not doing anything wrong, but that is a change in the way they're doing their accounting. And then there's this second category, which is accounting for errors. And accounting for errors, these are a little more serious and usually carry negative consequences. And so what happens here is there's either an intentional, but most often it's an unintentional mistake. It's a misstatement. And so they presented some financial information and they've misstated it. Or they thought that they were applying an accounting rule the right way, but after a subsequent review, they realized, oh, we had not been applying this the right way, or someone else may have figured out, like an auditor or the SEC or the PCAOB. These are all different organizations that oversee financial reporting. They may have discovered the mistake. And so it's either a misstatement where the information is just wrong, or it could be that the information is correct, but the accounting rules were not applied properly. The vast majority of time, when there is an error, it is an unintentional mistake. The things we read about typically are those few exceptions where there is some sort of intentional mistake, where there's fraud or something like that. And obviously, if there's fraud, that's when people go to jail. But I also want you to be aware, if there's an unintentional mistake, it doesn't mean companies still get sued over this, and auditors still get sued, even when there's an unintentional mistake. Because the fact remains, people use that information, and if it was created with error, they may have made decisions they otherwise would not have made. And so you can get yourself in a lot of trouble. Hold on, I have a little flashing light here. You can get yourself in a lot of trouble if you don't apply accounting principles the right way. And so all of that to say, these are big issues. The accounting errors are a little more serious as far as there being legal and financial issues, but all of them are important to kind of go through. All right, so we're going to go into a little more detail on changes in accounting principle. So there are different approaches that we could use, or different approaches that the FASB considered using when it comes to changes in accounting principle, or for any other change or error. So there's one approach, which is to apply the changes currently. So what you do if you were to apply the changes currently, there would be a cumulative effect. So like LIFO versus FIFO, well, you've had inventory for 20 years, and so the income effect of that kind of accumulates over time. So under this approach, what you would do is you would take that cumulative effect, and it would only be reported as a change to income in the current year. So there would just be some massive adjustment to this year's income, which would roll up all the prior year's differences into one number. That could be a substantial number, it could be a small number, but this is one acceptable approach, or one possible approach that the FASB could have adopted when applying changes in accounting principle. In this situation, they don't restate any prior years, they just basically report it just as it was originally reported. A second approach is what's called a retrospective approach, or apply the change retrospectively. So, Harry, as far as the currently, there is nothing. So we don't. Again, we're going to get there. I'm going to talk you through the three, and then I'm going to talk about the one they actually use. The second approach is what's called the retrospective approach. And what you do there is you actually recast previous financial statements as if the new principle had always been used. Now, the key here is that the firm restates all presented financial statements, and so you always have 2 years balance sheets and 3 years income statements, and so all of that information would be reported as if the new principle had always been used. And so you have to go back and think about, okay, what would the inventory balance have been? What would cost of goods sold have been? What would net income have been? And you have to kind of work through and make all those changes to anything that's presented. Now, there obviously, for some of these changes in accounting principle, there could be effects that predate anything that's presented. In that situation, then you just make an adjustment to the earliest retained earnings that are reported on your financial statement. And so just be aware of that. All right. The third approach that is a potential approach is what's called the prospective approach. And basically, you only apply the new standard going forward. You don't make any changes. You don't make any changes to income statements or this year's income. You don't make any adjustments whatsoever. You just basically say, okay, now let's use the new principle, come what may. And so that would be the third approach that we could have used. Now, as far as what FASB adopted is they actually adopted the retrospective approach, which is the most comprehensive. It provides the best information, and so that's the method that we use. All right, there are two primary steps whenever we have a change in accounting principle. The first is you need to make adjustments to financial statements for all years presented. And the second thing is you need to adjust the carrying amounts of assets and liabilities as of the beginning of the first year presented, and then retained earnings is adjusted for the cumulative income effects prior to the first year presented. So again, anything that's presented, you have to make adjustments to the financial statements, and then you have to look at carrying amounts for assets and liabilities from the earliest year that they're presented. And basically, you have to then accumulate all of that and present it all as if the new principle were always being applied. There are some required disclosures. First of all, you do need to disclose the nature and reason for the change. Second of all, you do need to disclose the method for how you applied to the change. And you also need to describe the prior period information, any effect on changes in income, and any cumulative effect that's been reported either in retained earnings, equity accounts, or anywhere else on the balance sheet. So again, this is just disclosing what happened, disclosing the financial implications of what happened, so that anybody who looks at your financial statements can reconcile what they see in the current financial statement compared to what they may have seen in previous financial statements. And so it's a fairly lengthy disclosure, just so you're aware. All right, so let's talk about the 49er company. So in this example, 49er company started its operations on January 1st, 2019, and they used the LIFO method for inventory all the way through December 31st, 2021. And then this is the income statement information for those years. And so they reported net income of $10,000 in 2019, and then $12,500 in 2020, and then $11,000 in 2021, all using the LIFO method. So the related inventory balances using the LIFO method was $4,000, $3,500, and then $4,000 again in 2021. So again, these are just the ending inventory balances for all of those 3 years. Okay, so as of January 1st, 2022, the company transitions from LIFO to FIFO. And so what we do then is we have to recast all of our financial statements. And so that means you need to figure out, okay, given that we switched to FIFO, what would the net income have been if the company had used FIFO? Now, the nice thing is, for the purpose of this class, I'm going to provide that information for you for something like this. And so I give you the net income under FIFO. So it's $12,000, $13,000, and $12,300. And so again, this is just a transition from LIFO to FIFO. And if they had used FIFO, their net income would have been different. And I've given you the different amounts that would have been reported if the company had always used FIFO. Now again, originally, the company would have reported $10,000 in 2029 or 2019, 12.5 in 2020, and 11,000 in 2021. And so then behind the scenes, the company is now going back and calculating what net income would have been under FIFO. And that's where we get these numbers. Again, I'm just providing them to you so that you don't have to worry about trying to figure that out. All right, so then what we have to do, so now that we have all this information, we have to figure out, okay, do we need to make any updates to our actual accounts? All right, so in other words, we have account balances, and now that we're going to change the accounting principle, these changes are going to kind of roll up, and we've got to figure out what the implications from that might be. What is the point of using this approach, changing previous information? So the idea here is that there's now whatever you see in 2022, you're going to see a consistent application of the accounting method. In other words, it would be very odd to be looking at 2 years of income, to look at income statements, some of which are prepared using LIFO and others that are using FIFO. It might be confusing because it would skew profit margins and account balances and things like that. And so this is the FASB's way of allowing someone to see financial statements that are created under a consistent approach. So that's kind of the big idea there. All right, so then we've got to figure out, okay, is there a journal entry that's necessary? In other words, do any of our permanent accounts, do we need to change any of those account balances? And so, well, let's figure it out. So the first thing you look at is, well, let's look at the cumulative income under LIFO. And so under the 3 years, there would have been a total of $33,500 in income if under LIFO. If we had used FIFO for those 3 years, our cumulative income would have been $37,300. So what's important here is getting back to the conceptual framework, where we know that there's a connection between the balance sheet and cumulative income. In other words, if there's a change in the balance sheet, that means there's going to be a change in cumulative income. If there's a change in cumulative income, that means there must be a change in the balance sheet. Now, understand, like you might have some things that completely offset each other, like an asset goes up and a liability goes up by the same amount. So I mean, there are some exceptions. But the idea here is that if there's a switch, if there's a change in our cumulative income, then there must be an effect on the balance sheet at a minimum. We know that retained earnings are where we accumulate income. And so in this case, we understand that, oh wait, under FIFO, since we're going to be retrospectively applying this principle, we need to change the balance in our retained earnings account. If I need to change the account balance in my retained earnings account, there must be at least one other account that's affected by this change. Otherwise, you can't change the balance. Obviously, that would throw off the balance sheet. And so what we're seeing here is that there is a cumulative effect. And since there's a cumulative effect, there must be a journal entry. And so that's what we've got to now work through next. So this cumulative difference is $3,800. In other words, there is an increase to our cumulative income under FIFO compared to what we had originally reported under LIFO. Again, calculate that cumulative difference in income. That's a very important first step. Then you can start to understand what you have to handle from there. The cumulative difference in income. All right, so now let's get to the journal entry. So what accounts are going to be part of the journal entry? Again, hopefully we already have illustrated, hopefully it became clear that because there's an increase in cumulative income, there's going to be an increase to our retained earnings account. The offsetting piece of that is going to be inventory. So in other words, because the way that we handle our inventory, LIFO versus FIFO, that effect accumulates in retained earnings, but it also must accumulate one other place, at least one other place. And in this case, of course, hopefully that makes sense that it's the inventory account balance. And so while there's going to be an increase to cumulative income, and that's going to show up in retained earnings, there must also be an accompanying increase to inventory, which is going to increase that asset account balance. So journal entry, we increase the balance in both. That's a debit to inventory and a credit to our retained earnings. And so whenever you have one of these changes in accounting principle, you have to keep it sort of pay attention to understand, okay, what is the cumulative effect? And then given that if there is a cumulative change, what accounts are going to need to be changed as part of the journal entry. And so in this case, $3,800 increase to both inventory and retained earnings. So that's kind of the first part. Do the journal entry first. Then the second part is to think about the financial statements. So in 2022, so we got to kind of think about in 2022, they will have to present 3 years of income statements. So they would have to present 3 years of income statements: 2022, 2021, and 2020. So they would have to report all 3 years. Now, obviously, 2022, there's nothing to restate there because they used FIFO starting at the very beginning, and so there's nothing really to worry about. However, 2021 and 2020 are going to have to be restated or recast. And so when we think about what had been originally reported, what I've given you here is for those 2 years, this is what was originally reported. And so they originally reported in 2020, they reported sales revenue of $85,000, cost of goods sold of $53,000, other expenses of $19,500, for a net income of $12,500. And then, of course, we can see different numbers for 2021. And by the way, on a test, you are going to need to be able to do this sort of thing. Look at financial statements and figure out, like, okay, given the originally reported amount, given some sort of change, can I now present a restated income statement or a restated balance sheet, which is what we're going to see in a second. So this is very important that you understand how to go from that journal entry that we just did, the $3,800, to go from that journal entry and to go down now into the income statements and think about what may have happened here. Okay, so I'm going to kind of point you back to that table where we looked at the difference in income on an annual basis. And so you can see that under LIFO and FIFO, there's a difference in income in 2019, 2020, and 2021. Now, the journal entry that we just did, that is a cumulative effect. So in other words, that $3,800 is all years rolled up into one number. However, we know that an income statement is an annual disclosure. In other words, it's talking about income just for that year, just for 2019, just for 2020, just for 2021. And so when we're talking about the journal entry, it's the cumulative effect. When we're talking about the income statement, we need to think about the annual effect. All right, so for 2020, we need to think about what happened just in 2020. Well, just in 2020, you can see that there's a difference in income of $500. And so in 2020, you can see there's a difference of $500. And so then we have to think about, okay, given there's a difference in $500 due to the way we accounted for inventory. Again, very clear here, due to the way we accounted for inventory. And so given these 3 items, sales revenue, cost of goods sold, and other expenses, where do you think that $500 difference should show up in our restated financial statement? So where should it show up? And so if in the chat, so we have Jason saying cost of goods sold. Anybody else? Harry Smith, retained earnings. Now remember, we're on the income statement right now, Harry. Decreased cost of goods sold. Aiden says revenue. All right, so it is in our cost of goods sold. So the sales revenue does not change. The way that we account for inventory does not change how much we sell that inventory for. And so there's no difference in our sales revenue. However, it does change the way that we account for the cost of the goods that we sell. And just as Jarrett had pointed out, that to have an increase in net income, there must be a decrease in cost of goods sold because it is an expense. And so the restated cost of goods sold would be $52,500 in 2020. What would it be in 2021? So someone real quick in the chat, what would be our cost of goods sold in 2021? Again, we got to look at what happened in 2021 and then apply it to the cost of goods sold that we see here. So we're asking Harry for the restated cost of goods sold. So Nate and Jason both say 57,700. Yep, I got it, Nate. Yep. And that is correct. So the restated cost of goods sold for 2021 would be $57,700. Now, how did we get that? We can see that net income, there's a difference in net income in 2021 of $1,300. So again, given that this is a change in the way we account for inventory, the only thing that would account for that change in net income is a change in cost of goods sold. For net income to go up $1,300, that means cost of goods sold must be adjusted or restated downward $1,300. Again, you're probably already sensing how this can get a little bit confusing, and you really got to kind of pay attention. The accounting is not that difficult, but paying attention to the direction and all that kind of stuff, I totally understand that can be a challenge. Other expenses are unchanged, and that's how we get our restated net income of $13,000 in 2020 and $12,300 in 2021. So again, I think the way, and somebody verify, I tried to give you, I think I gave you these tables in your notes, and you just had to fill in the restated column. Good, that does make it more efficient. The first time I did this, I actually forgot to include a table that they could fill out, so you could imagine how much people were scrambling to write everything down. Yes, Nate, you will be given the original amounts, and then you have to provide the restated amounts. Again, it may not be an inventory question. It could be something else, but that's right. Okay. All right, so now let's talk about the balance sheet. Now, again, they present 2 years balance sheet. Ryan says, it really depends. So Ryan, I mean, most systems are fairly automated, and so making that change probably is not that difficult. However, making sure that everything's done right and making sure everything's tied together correctly, that can be a fairly tedious process. And so anytime there's a change in accounting principle, there's going to be a lot of eyes on it. So I guess the manpower cost is probably, it could be a good bit, which is why companies don't change accounting principles very often. All right, so it should say actually 2022 financial statements. I updated this lecture but missed that date. So in 2022, again, they have to present 2 years balance sheet. So they will present 2022, obviously, and then 2021 as well. And so now we have to think about what's going on within 2021. Now, we said the income statement was an annual effect. In other words, each year had its own effect that we needed to keep as 2021. And on a test, I'm going to do the same thing. I want to make sure that it kind of nicely aligns so that you don't have to kind of figure out, oh, it's partial year, what do they do? Or we're not going to do that kind of thing. So don't worry about that. So again, so here you can see we have inventory and other assets. We have liabilities, retained earnings, and other equity. And so real quick, in the chat or in your notes or both, let me know basically two things: an account that you think is going to be restated, and the new balance. And so I'll give you a hint. There are two accounts. Well, two main accounts, and then obviously total assets and liabilities are going to change as well. But give me the account name and the restated amount. So Harry says inventory 5,300. Harry Smith says retained earnings 34,800. Jason Hall inventory 7,800. Nate Newland total assets Sorry, one of my kids poked his head in the door. That's why I keep turning left. And hopefully this allows some. I noticed some people kind of fell a little bit behind, so I'm also gonna. This kind of allows some people to catch up. Again, I'll give you a hint though. Remember, the cumulative effect was $3,800. The cumulative effect was $3,800. I see two right answers on the inventory, so we'll go ahead and post that one. So yeah, the inventory, $7,800, which then of course is going to change our total assets to $109,800. Again, the cumulative effect of $3,800. Yep, Aiden, good job. 7,800, good job. I just want to make sure, does everyone understand why the inventory account balance needs to change the full $3,800? And again, it's because that account is going to capture the cumulative effect. Harry had said $5,300, which was just the difference in 2021. But remember, on the balance sheet, you accumulate 2019, 2020, and 2021 all together because the balance sheet accumulates the effect. So then retained earnings. Aiden said, looks like Aiden thinks it's going to go down. Numakumar thinks it's going to go up. Jason also thought that the retained earnings were going to go up. And the answer is the retained earnings actually do go up. Again, they increased the same $3,800. Liabilities and other equity, that all stays the same at $22,500. And so the new account, the new balance for liabilities and equity must be the same as total assets, which is why it's $109,800. But again, the retained earnings account, it accumulates all 3 years, right? The full 3 years, the cumulative effect. Sorry, I need to look at something real quick. All right. All right, how are we doing with that one? I will say this is probably about as simple as it gets. So if I know that might be kind of one of those moments where you're like, that was not easy. I get that, but there are definitely more complex accounting principle changes that you might have to deal with. This is pretty much as simple as it can get. All right, let's talk about some of the other accounting changes. So let's talk about changes in accounting estimates. Again, this would be like changing the useful life on a depreciable asset is a classic example of that. So for those changes, they are applied prospectively, which means basically you just apply the change going forward. You don't restate or amend anything prior. You don't accumulate the change in income you don't do anything like that. You basically just say, okay, let's recalculate depreciation expense and apply that going forward. And so that's a fairly simple change as far as the change in accounting estimate. Changes in reporting entity. They do have to disclose the nature of the change and any impacts on reported income, especially because a lot of times when you change the way you organize your company, that's going to change inter-subsidiary transactions, and that can greatly affect the way that you report your sales, your cost of goods sold, and potentially income. But a lot of times through those eliminations, income doesn't end up being changed that much. You have to report the current year, the consolidated financial statements according to the current state of the company. So, same idea. If you got to kind of act as if you were reorganized in the prior whatever's being presented, and so that current year needs to look like the current state of the company. So again, you need to make sure that you don't. The idea is to provide transparency to any users of those financial statements. I'm trying to move a little slower because I can see we're at about 14 concurrent viewers, and I think we were a little higher than that. I just want to make sure that no one's too far behind. Is a change in quarterly guidance the same as change in accounting estimates? So Ryan, when you say a change in quarterly guidance, I'm not sure exactly what you mean. That can mean a lot of different things. So you'd have to clarify if um, if they did an estimate on a quarterly financial statement and then let's say the annual number came in differently, that is not the same thing as this. So interim financial reports are kind of their own thing because they're unaudited. But when you talk about an annual financial report, that's one where we're talking about this type of thing. Okay, so accounting errors. So we're gonna be spending. Oh, so if the manager provides guidance, then no, that's not what this is. Nope, not at all. That's just a manager estimate. All right, so accounting for errors. This is definitely we're going to be spending a lot more time, and this tends to be a little more serious. And so I want to make sure that we're clear on how to handle these errors. Again, errors can be minor. They can also be quite significant. Some companies have had to restate, a decade of earnings. Sometimes companies had to restate, and the restatement was in the billions. Sometimes it's hardly even a rounding error. So it really does depend on the situation. So again, these can be quite minor, or they can really be significant. So for errors, they have to actually restate all affected periods. Doesn't matter how many, it doesn't matter how far back they go. If an error affected a period, you must restate that period. And basically what you end up doing is you usually there's either a press release or what's called an 8K where they'll report that, and then usually in the subsequent 10Q or 10K they'll actually get in a little more detail to show you the full effect of any error that was made. But these can be quite significant, quite involved. Sometimes, though, it's minor. They might have just discovered a mistake in their first quarter, their 10Q in the first quarter, and they're like, there was an error, we need to fix that. So again, it can vary. They do have to disclose the nature of the error as well, basically what happened and how it's been addressed. Sometimes they'll even have to disclose whether the error was the result of like an internal control material weakness. So if there's something wrong with their system, they need to disclose that. And so there's a lot of information that can go into these disclosures when it comes to accounting errors. So change, similar to a change in accounting principle, I want to be very clear, the firm may require a journal entry to correct the error. So again, if the error, some errors have been what are called, we're going to get into the details of it, some errors have been counterbalanced and some have not. So you always have to think about, do I need to correct a permanent balance? And if the answer is yes, then you need to make a journal entry. And if the answer is no, then there's no need for a journal entry. So I kind of previewed this. So there is something called a counterbalancing error, and a counterbalancing error corrects itself in one period. So as an example, if a company has an incorrect inventory count in 2020, as long as their inventory count in 2021 was done correctly, then the error in 2020 was counterbalanced. So it's a counterbalancing error. So now it tells you, let's say I discover that I messed up in 2022. Well, there's no journal entry that's required because the error has already been counterbalanced. Now, I still have to go back and restate 2020 and restate 2021 because the cost of goods sold is wrong in both of those years, and the inventory balance in 2020 was also wrong. And so I actually have to go in and I have to report all that information. I have to provide corrected financials restatements, but there's just no journal entry because the error had been counterbalanced. And so not all errors are counterbalanced, but many of them are. So a non-counterbalancing error does not correct itself after one period. And so let's say that every year the company, just for whatever reason, had not been counting inventory in transit, and that was a mistake that they just kept making and kept making and kept making. In that case, it really did not correct itself. And so there probably is some correction to that account that you're going to have to make, at least at a minimum. If I discover the error in 2022, I probably need to correct whatever mistake I had made from left over from 2021. Again, I still have to go back and restate all prior years, but in that case, there likely would be a journal entry as well. Again, this is just the idea that there may be a journal entry, but there also may not be a journal entry. All right, so let's go through an example. So 49er Company incorrectly calculated the fair value of its passive equity securities in 2000, wrong year, it looks like, or 2017. I think that should say 2020. The securities cost was 12. I'm going to just fix that right now because it's going to bother me. Oh, I don't want to do that. Why did it do that? Well, this is becoming a bigger problem than I thought it was going to be. All right, bear with me. Where are we at here? So bothersome. Now I want to go full screen. All right. All right, so the incorrectly calculated the fair value in 2020. The original cost was $12,500. The firm had reported a fair value of $15,000, but they should have reported a fair value of $17,000. So you could imagine on a test being provided this type of information. And so in some cases I might ask you for the journal entry. In other cases I might ask you for the updated account balances. I kind of vary it, but just so you're aware, again, this is kind of the skills that we're doing on this problem are skills you're going to have to demonstrate on the test. And so now I give you the original income statement from 2020. Again, the sales revenue, they do have, because this is a passive equity security, you just have to remember that, oh yeah, that you have the unrealized holding gain or loss that's reported as part of net income. You have other expenses, and then in this case we're actually going to include any tax effects. So that's going to be a major complication for this problem, is we're going to include some tax effects. And I will say on the test, sometimes I'm going to ask you to account for the tax, and sometimes I'm not. But I will make it clear in every case where you need to handle the tax effects, or at least where you can ignore them. And so all this to say, given this information, we need to figure out how to correct this error. Again, then we have the balance sheet. And what you can see here is I showed that they reported the equity investment net, which means the original cost plus the fair value adjustment. They reported it at $15,000. I also give you deferred tax assets, deferred tax liabilities, and other necessary accounts. And again, total assets equal total liabilities and equity. So basically, this is all the information that was originally reported. Now we've got to go back and figure out, okay, given this error, first of all, is there a journal entry? And then second of all, do I need to make any corrections to these accounts? All right. Journal entry. So let's talk about the fair value adjustment account, because that's going to capture the full effect of what's going on. So we have this fair value adjustment account, and we're going to talk about three things. We're going to talk about the full effect, we're going to talk about the tax effect, and we're going to talk about the after-tax effect. And so when we talk about the full effect, the underlying asset or liability, that's where the full effect is going to show up. In this case, as part of our fair value adjustment account. That's where the full effect is going to show up. And so we know that the restated fair value account or adjustment account balance should be $4,500. Well, how do we know that? Well, the original cost was $12,500, and we were told the fair value that the correct fair value was $17,000. And so that tells us the fair value adjustment account balance ought to have been $4,500. But they only reported a fair value account adjustment account balance of $2,500. Again, they had reported a fair value of $15,000, not $17,000. And so what that tells us is the entry amount to the fair value adjustment account should be a $2,000 debit. That increases the fair value adjustment account balance. Again, $4,500 is what they should have reported. $2,500 is what they did report. And so we need to now make an adjustment or adjusting entry to change the account balance in our fair value adjustment account. Again, I'm trying to go slow, but the full effect is going to show up there, so I need to calculate what that full effect is. All right, so now the next piece. There is a deferred tax liability related to this asset. Now the deferred tax liability, or if there had been a deferred tax asset, those are going to capture the tax effect. So you have the full effect, and now we're going to talk about the tax effect. All right. So we know that whenever you have an increase in the fair value of an investment, that under the Internal Revenue Code, that passive investment, that passive equity security stays on the books at cost. But under US GAAP, they report it at the fair value. And so since there's a difference in the book value of an asset, we know there must be a difference in cumulative income. If there's a difference in cumulative income, there's going to be a difference in the cumulative income tax. And if there's a cumulative difference in income tax, that means there's going to be a deferred tax asset or a deferred tax liability. And in this case, the cumulative income under US GAAP is more than what was reported under the Internal Revenue Code. And so since it is greater than, then it's a situation where we have a deferred tax liability. All right, so let's talk about the deferred tax liability. The restated deferred tax liability account balance is 40%, which is the tax rate, of the difference in the book value under US GAAP compared to that same book value under the Internal Revenue Code. And so in this case, we know there's a $4,500 difference because of the fair value adjustment. And so we apply the tax rate of 40% to that difference. And so that tells us that the restated deferred tax liability account balance should be $1,800. The amount that was reported was 40% of $2,500, which is $1,000. So you can see that they should have reported $1,800 for their deferred tax liability. They actually reported $1,000 for their deferred tax liability, which means they need to increase their deferred tax liability by $800. You'll also notice that $800 is 40% of the entry amount for the fair value adjustment account. That's going to be true. Again, the full effect versus the tax effect. And so if we have the full effect, the tax effect, the only thing that's left is the after-tax effect. So the after-tax effect is captured in retained earnings. That's where the after-tax effect shows up. So let's talk about that. So first of all, the restated balance in the retained earnings account would be that $4,500, which is the full effect on income, less the tax. Remember, there would be an income tax expense on whatever that unrealized holding gain or loss, whatever that is. There's a tax expense related to that, which means there's an after-tax effect on retained earnings. And so the 60% applied to $4,500 gives us $2,700. And of course, what they had reported was the impact on retained earnings, or the after-tax impact on retained earnings, was $1,500, which means that the entry amount for a retained earnings account should be $1,200. Again, you could think of it this way. You have the full effect for the fair value adjustment account, the tax effect in the deferred tax liability, and the after-tax effect in retained earnings. And it must be the case that the tax effect plus the after-tax effect needs to equal the full effect. All right, that's just how it has to be. And so while I've done a fairly lengthy calculation here, as a practical matter, I'm just going to tell you, as a practical matter, when I get to the DTL and the retained earnings accounts, I don't do those first two bullets. I just jump right to the entry amount because I just take 40% of 2,000 and I know that's the tax effect. And I take 60% of 2,000 and I know that's the after tax effect. If the tax rate had been 35%, it'd be 35% and 65%. So you can always break it up. Now you do need to figure out when you talk about the tax effect, is it a DTA or a DTL? You do need to figure that out. And for the retained earnings, you need to figure out, am I increasing retained earnings or am I decreasing retained earnings? So those things are other issues that you need to address, but at least the amount can be known. The amount can be known fairly quickly. And then figuring out whether it's a debit or credit, well, that's obviously, that does take a little more thought. And I would say for most students, if you focus and just try to get the amounts, you'll get half the credit. But just because, let's say you can't figure out debits and credits and all that kind of stuff, well, don't give up on the calculation that you can do just because you can't figure out everything. Harry says, do we credit retained earnings in lieu of an income account because this is after? Yes, exactly. And so when we talk about journal entries, Harry, given that there has not been an effect in the current year, in other words, we've closed everything, then the only accounts that are going to be subject to a journal entry are permanent accounts. Now, I will say, there could be a situation where you discover an error sort of during the year, and in that case, there would be temporary accounts that may need to be corrected. So let's say that I had recognized some revenue in March, and then I realize in July that I probably should not have recognized that revenue yet. Well, that revenue account has not been closed, and so I'd actually need to make an adjustment to the revenue account. But in this case, because everything's been closed out, the only candidates for the journal entry are those permanent accounts. No, Harry, we did not. So for the journal entry, when we talked about the cost of goods sold, we did not have an entry to cost of goods sold. The entry was to retained earnings and inventory, both of which were permanent accounts, because we made the change on January 1st, 2022. Now, if we had made the change partway through the year, then there may have been the need to make a change to cost of goods sold, but I'm not going to do that to you. All right, so let's talk about then the journal entry. Again, we've taken all the information that we just calculated and now we're throwing it into a journal entry. We're increasing the fair value adjustment account by the full effect, $2,000. We're increasing the deferred tax liability and increasing our retained earnings. Of course, the DTL is the tax effect and the retained earnings are the after-tax effect. Again, we're breaking up the full effect into two pieces. And I just chose April 10th, 2021 as a date where they discover the error. It would be whatever date that it's discovered on. All right, so now we need to continue with this error and figure out, okay, now we need to figure out our restated financial statement. So in 2020, I've still provided the as reported amounts, the $63,000, and then the unrealized holding gain or loss is $2,500, other expenses, and the income tax expense. And so what I want you to do, and I'm going to give you a hint, I'm going to go back. Now look at those amounts, $2,800 and $1,200. Now I'm going to tell you right now, all three of those numbers show up in some way on this financial statement. In other words, those amounts are important. All three of those amounts are important somewhere on this income statement. And so I want you to try to do in the chat or on your own is give me the restated amounts for all four of the remaining accounts. So the unrealized holding gain or loss dash income, other expenses, income tax expense, and net income. So I want you to try to figure out the new restated amounts for all three of those items. Or four, I should say, all four of those items. But again, the $2,000, the $1,200, and the $800 all are important differences between what's been reported and what's going to be restated. So Jason says the income tax expense should be $10,200, which is an $800 increase to our income tax expense. See if anybody else comes up with something. So Nate says the unrealized holding gain or loss should be restated at $4,500. And then Harry's saying net income should be restated at $15,300. And we have hit all three of them. So again, the unrealized holding gain or loss, $4,500. Good job. The other expenses is the same. The income tax expense, of course, increases by the tax effect of $800, and the net income is restated by the after-tax effect. Now again, the nice thing about this particular example is there is only 1 year to worry about, and so that's why you can directly translate the journal entry amounts, which is the full effect, the cumulative effect, to these accounts because there's only 1 year that we have to worry about. But really good job on that. So again, we would have restated net income of $15,300, restated income tax expense, and restated unrealized holding gain or loss dash income. I'll give it a minute in case some folks hadn't had a chance to write that in. Oh, and by the way, sometimes on an 8K or when they disclose, or in a press release where they disclose these restatements, you will literally see the original financial statement and the restated column right next to it. And sometimes they'll show you line by line where the effects take place. I will say other times they're less clear. I've seen disclosures on this in paragraph form sometimes, where they just say, in da 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 da, we restated this amount for these. It does vary as far as what is disclosed. One of my major areas of research is actually on restatements, so I look at this stuff a lot. All right, now let's talk about that balance sheet. Again, this is the balance sheet that I had provided before. If you are able, if you know there's a restated amount for any of the accounts that you see here, go ahead and in the text, or sorry, in the chat feature, fill in or give me that information. Again, we're kind of looking at a lot of different things here. And so on a test, don't be overwhelmed by the massive number of blanks. Make sure you kind of walk yourself through it. So we have a DTL 4,300, the equity account 17,000. Is that 117,000 maybe? I'm not sure what so sorry Harry, I'm not sure what that one is. Jason says retained earnings 35,200, which is an increase of $1,200. Kumar, get the same thing for retained earnings. Harry, equity investments. Equity I. I'm with you now. 17,000. Good. Nate says the DTL agrees that it should be $4,300. I think we got them all. Now, the only thing I will say is the total assets and liabilities and equity are going to have to change as well. But again, as Harry pointed out, the net equity investment is now going to be restated and reported at $17,000. The deferred tax assets don't change, other assets don't change, and so total assets is going to be restated at a total of $133,000. Good, Nirmal Kumar, good job. Other liabilities don't change, and as you guys had pointed out, the retained earnings does increase by the tax amount, or the tax effect of $800, for a total of $4,300. The retained earnings is increased by the after-tax amount of $1,200. Other equity is unchanged, which means liabilities and equity is also $133,000. Good job. Good job. Again, the translating the journal entries to the balance sheet and income statement, that is a challenge for sure. You will be tested on it. Now, it's not the whole test, but enough points where it matters. And like I said, that took a little long. It took about an hour, which isn't too bad. So if you have any more questions, now's the time. But as you're thinking or typing your questions, I will say, again, what I'm going to do is there are several practice problems related to the Chapter 22 material. And so what I'm going to do is, and I'm not sure if my YouTube channel allows me to do this, but if I can rebroadcast the original stream that I had done last spring, I'll do that. At a minimum, I'm going to move that lecture into the live lecture folder, so it's kind of one-stop shopping. So it will be there one way or another, but I'm going to see if I can rebroadcast that stream. Now I won't be responding to any questions you might have in the chat. I don't even know if it enables the chat in the rebroadcast. I don't know. That's a new part of this world to me. But if you either ask a question in the comments or if you just email me questions, I'll be glad to answer. So I will say, if you do it in the comments, that kind of would benefit everybody. That's probably my preference. But at the same time, I understand you may not want that to be kind of out there permanently for everybody to see. I get that. All right. I don't see any questions. But everybody, thank you for tuning in. And tomorrow we'll be doing statement of cash flows. That will be another kind of tedious process, so be ready to take some notes. What exactly will be in the video? So Aiden, there's several practice problems on Canvas. And what the video does is it walks you through the solution. So that I give you the solutions, but it's just kind of sitting in front of you, all the numbers. And instead of just sort of seeing all the numbers, I walk you through exactly how those calculations are made. So it's just extra practice. Any other questions? No problem, Aiden. Okay, everyone. Well, thank you so much for tuning in, and I will see you all tomorrow. Take care.